Welcome to Mastering the Math of Business with Lauren Young. Today we're going to be discussing the R in business CPR, and that has to do with reporting. Reporting is a foundational element to making better decisions. It's a key component. In fact, what is important to appreciate about reporting is that the data or the transactions of your business either get used and become information that drives insights, make for better decision making, smarter actions, and superior results, which then generate new data that gets captured and the cycle just continues. Or it doesn't get used at all. And in small businesses, it's more likely that it's not going to get used at all. And the reason for that is that it takes a little bit of effort to understand what you're looking at, to appreciate what's there, but it doesn't take a lot of effort. And one of the things that just absolutely fascinates me about the difference between my corporate days and my working with small businesses is the difference in approach relative to reports. Big businesses use reports day in and day out to appreciate what's happening in the business. They are particularly dialed into the month-ending reports that give them a look at what's happened in the most recent month through their financial statements. And they do this because they recognize that their top line and bottom line is a function of how much they sold, what it cost them to generate those sales, and what's left over is their profit. The size of this is a big deal. The other thing they are looking at is the assets in the business represent the resources used to generate sales at a profit. And those assets are funded in one of two ways. They're either funded through liabilities or through owner's equity. And that's why they use these two core financial statements. They use the P&L statement to look at income or sales minus expenses to equal net income, and they look at the balance sheet because their goal is to maximize the use of these assets to then maximize the equity in the business, with the net income through any cycle rolling over, and it's the only part of the P&L statement that shows up on the balance sheet in the form of retained earnings. So one thing I want us to appreciate in this edition of Mastering the Math of Business is that big corporations won't go a month without looking at their financial statements. In fact, they're often looking at reports much more frequently to keep a pulse on things, whereas small businesses don't. And the difference between using your reports and not using your reports, i.e. your P&L statement and your balance sheet, is a function of hard dollars. In other words, less money is always made in businesses that don't benefit from their reporting. And you can see that when you look at how significant this can be. So again, here's a business, and these are their planned outputs. 12.2 million in sales, 2.2 million in net income. And this is their asset base that they're going to use to convert these sales into these profits. These are the liabilities that exist in funding those assets, and this is the equity that owners have in association with these assets. As you can tell, this is a really well-run business. Most of the time, the numbers aren't this high. This number is about right, but this is a much bigger number than this is because most assets get funded through liabilities as opposed to equity. And a big part of this business's equity is their retained earnings because they consistently make money. Let's look at a couple of conditions, and really the conditions that I'm wanting to illustrate here is those who rely on luck and those who use their reports. And you can really see this when you look at the impact of change in sales and the change in costs on a business. So here's a business that relies on luck. In other words, they aren't working to a plan, nor are they using their reports to adjust their actions that are going on across the business, because they aren't pausing to reflect on what's working well and where are they getting stuck. So a business that loses this much in sales and spends this much more than they should would experience a 13% return on sales as opposed to an 18%. In other words, they would drop 5% out of their profits through this combination. Now let's take a look at what is possible when you do use your reports. Your sales go up and your expenses go down. That's what happens, because you know what's working and you build on it, and you know what's not working. So here in this scenario, this bump would generate this much in net income. In other words, they would go from earning $2.2 million to earning almost $3.2 million. That's a change of 7% in their return on sales. Isn't this a much better place to be in? That's the goal. That's what you're working towards. So with all videos, I'd like to add a call to action here. And that call to action is really targeted to those who are struggling to understand their financial statements, who've never been given the opportunity to have someone walk them through what their P&L statement and what their balance sheet is telling them about their business. In fact, in this video, if you go to business-cpr.com/F7, that's /F7, you can schedule a free assessment of your financial statements. And one of our certified business scientists will take a look at your financial statement, and they will tell you what your financial statements are saying about your business and offer you some helpful tips on how to benefit from them so that you can make more profitable decisions. As with all videos, this is an opportunity to do something different. And it really comes down to wanting to be better and get better. Use these two statements to do that, and it will happen. Thanks again for tuning in. As always, I welcome comments, questions, and suggestions. Likes are always appreciated, and subscribe, because a subscription will expose you to more things like this, all built around helping you make more money with less stress so that you can enjoy both your life and your business. Thanks for tuning in.